Danny Ratliff joining me this morning, of course, certified financial planner, talking a little bit about Biden and taxes and all that other kind of good stuff, right? Because if Congress, which is on recess right now, if they don't raise the debt limit and get some funding passed for the Treasury will hit their X date in November, which means that they will no longer be able to pay bills without emergency, and they're on emergency measures now to pay their bills. And of course, that means, problems potentially for other kind of non-mandatory spending. Now, this is something that's very important to understand. And this is where everybody gets all up in angst about the debt ceiling. They go, oh my gosh, if we run out of the debt ceiling and we don't get it raised and we run out of money, well, people aren't going to get their Social Security checks. Absolutely not the case. No matter what happens, Social Security, Medicare, Medicaid, veterans benefits, the military, they get paid. Those are all fall under mandatory spending. What doesn't get paid potentially are non-mandatory items in the budget, like Department of Education, which is teaching critical race theory. Don't know if that's a big loss or not. Since 1980, the education level in the U.S. has dropped markedly relative to the rest of the world ever since the government got involved in education. So maybe not funding them might not be a bad idea. But that's the big worry, right? So don't worry. Social Security checks will get mailed out in accordance no matter what. They get paid. And then once the debt ceiling gets raised and Congress passes their budget or whatever they're going to wind up doing, everything goes back to normal. So, and again, this is why we haven't had a budget since 2008 was the last budget that we actually had run by Congress. 2008, think about that. That was, over a decade ago. We've gone 2, 3, and we're in our third administration now without having a budget. And we're now relying on these continuing resolutions to help fund the government. So basically all that says is hey, continuing resolution simply, what did you spend last year? I spent $4 trillion. Okay, we'll give you $4 trillion plus 8%, and that's why our debt keeps going up and up and up and up, because we just use this baseline budgeting of 8% growth every year for all the budgets. We don't actually run a budget. Nobody's actually looking at the books. This is essentially having a bunch of children and in your house, and you give them a big pot of money and say, okay, make sure this lasts for the whole day. It'll be gone in about 5 minutes. So this is what's happening in Congress. Anyway, speaking of Congress, governments, and the end of capitalism as we know it, in many cases. Two other things. Yesterday, interesting outcome. El Salvador announced that they will now be accepting Bitcoin as legal tender. Sounds awesome. Right? This is what the cryptocurrency crew has been hoping for, is that somebody would accept and acknowledge Bitcoin as legal tender. What does that mean? That means that as a legal tender, you can use it to buy anything within the country, right? So in El Salvador, you'll be able to go down to, Starbucks or El Starbucks, whatever they call it, in El Salvador, and buy a cup of coffee, right, with Bitcoin, right? So you don't have to convert it back into dollars in order to use it. You can actually buy it with Bitcoin. And promptly upon the announcement, Bitcoin fell by almost 20% intraday as large positions started to liquidate. Coinbase, the new IPO of the company that just came out that is a transaction exchange for cryptocurrency, actually locked up. They had so many orders coming in to sell, they couldn't process them. Orders were getting canceled. It was a complete nightmare. Margin accounts were getting liquidated. And yesterday, this is a chart. If you're watching our live stream right now, I have a chart of the Grayscale Bitcoin Trust up, but a very sharp drop in Bitcoin itself. Dogecoin, as an example, dropped below 25 cents yesterday. It was just a disaster. And so the question really is twofold. One, if you listen to Kathy Wood, she was very optimistic about El Salvador acknowledging and accepting Bitcoin as a legal tender. She says this is the first step. This is great for it. The other problem is, I guess, from the other argument is El Salvador as a country has a bit of a spotty past. Is it really that great for a country like El Salvador to be accepting it as legal tender, right? So, considering that about 40% of cryptocurrency is used for illegal transactions, is El Salvador really the country that you want to have representing Bitcoin as legal tender? that's an argument that you can have all day long about Bitcoin. Is it, isn't it, whatever. But here's the real problem that really kind of brought to the surface yesterday with Bitcoin. If I was in the middle of a transaction with somebody, I was selling product, and let's say I was shipping product from the US to Mexico, and I had it on a truck and it was going to be in Mexico within 12 hours, right? And so within a 12-hour period, I've got a product to be delivered and I'm going to get paid for that product, and I'm doing it in Bitcoin. And all of a sudden, I lost 20% of the value of my shipment by the time the shipment gets there. That's generally my entire profit margin or more for manufactured products. So the problem becomes trade, ultimately, with cryptocurrency at this point. And it's any cryptocurrency. You can't have a cryptocurrency swinging 20% in a day and execute well on having some type of trade, right? So as a producer or manufacturer, as a customer receiving it, what I'm paying for it, what I'm receiving for it, can't be swinging around 20% in a day. So ultimately, the weakness of cryptocurrency as a legal tender for, say, somebody like the United States is really twofold. One, it's the depth of the currency to be able to handle $1 trillion worth of transactions. That's one problem. The other problem is the volatility of it. And until there is a situation to where the volatility slows down and you're not having these 20% declines and advances and runs all over the place. I mean, we just ran up 20% or so in Bitcoin. Now you just gave it all back up. In fact, you just round trip the entire price of Bitcoin in a month. So you can't have that kind of volatility in currency in order for it to be a part of an economic system, a viable economic system. It'll be interesting to watch how this works in El Salvador. But again, it is something that highlights the continued problems here. Again, nothing wrong with cryptocurrency. It's a speculative asset right now. But for it to be adopted as a legal currency and as a legal tender to essentially replace the US dollar as a currency, go completely digital, you've got to somehow figure out how to eliminate those swings of volatility and have something more stable. And at that point, that's why ultimately probably the Federal Reserve or some government, one part of our government or another, will come up, and it'll be the Treasury or the Fed come out with a digital currency at some point. We are moving in that direction. There's absolutely no doubt about that, because it's great for the country to be able to track every single dollar wherever it is at any time, where it's located, and be able to track the flow through the economy. That's a very important function for government. So again, when we get to that point, that'll be what we start to see here become actual legal tender. It'll be a government-issued tender. It won't be Bitcoin in the U.S., simply not large enough, not deep enough, and currently right now too volatile. When we come back from the break, we'll pick up with Danny Ratliff. Got to talk about taxes. 61% of households paid no taxes last year. So we're talking about tax the rich. What does that mean? We're going to talk a little bit more about Congress, what's happening right now with the spending bills that are coming up, Biden tax plans, and what about taxing buybacks? There's a novel idea. We'll come back and talk all about that with Danny Ratliff right after the break. Don't go away. Danny Ratliff, certified financial planner and beard model. If you're watching our live stream, Danny's been growing this beard. So exactly what is the trigger to get you to cut your beard this time? Is it when the market actually corrects, or what are we working on here?
Man, that's not a bad idea. I was actually thinking of when I can walk again, but I don't know which will happen sooner. Hopefully walking.
Oh, well, yes, hopefully walking. Actually, we'll get into that this morning. Morgan Stanley suggesting that we may see a correction before year end. So a couple of things here. I was just talking a little bit about El Salvador and what's happening with Bitcoin a second ago, but also one of the other kind of interesting highlights this morning. There's been a lot of conversation here as of late about let's tax the rich, right? The rich need to pay more. It's great conversation, and it makes for great headlines because everybody hates the rich, and they need to pay more taxes. But the top 10% of income earners pay about 80 to 90% of all the taxes already. It was an interesting chart out this morning showing that 61% of households, and these are mostly the households in the this is like the lower 61% of households, actually paid no taxes. And when you get down to the 20% of income earners,
they're actually getting money back from the government every year. So there'd be tax credits and all these type of things. And so, I just thought it was an interesting situation here because we keep trying to figure out a way to tax people that make money more money, which is actually detrimental to economic growth because, again, as you tax them more, they tend to be the business owners, right? So let's go after those guys like Amazon and let's get Jeff Bezos and let's go get, Elon Musk and Bill Gates. We need to go get those guys and make them pay more taxes. Don't forget, they run companies and they have product that you buy. And so if you tax them more, all they're going to do is raise the cost on the goods and services they provide. And this is the one thing that people kind of miss is that's the trickle-down effect that we always talk about in government, right? It's like, what's the trickle-down? The bottom 20 to 30% of income earners, they may not pay any income tax, but they actually have the highest tax rate in the country because about 60 to 70% of all their income goes to just paying for living needs, if not more. In a lot of cases, it's even more than 70%. But when you raise the cost of goods and services they use, that's the tax they pay, and they get hit the most by it.
Well, and that's exactly right, Lance. That's a big problem is that we don't see the wage growth keep up with the inflation. And you want to talk about an inflationary environment that they're creating. This is going to have a lot of negative connotations to it. I mean, this is a very aggressive tax hike, what they're trying to accomplish. They're looking at, raising the individual tax brackets. There's no question on that. I think that's going to go up. They're looking to raise that from 37% to 39.6. You also have that 3.8% Affordable Care Act, the Obamacare stipend on top of that for top income earners. They're looking at raising capital gains rates all the way up to that 39.6. That one may be a little bit more aggressive. There's some pushback even amongst Democrats with that. Step up in cost basis, the estate tax. You want to talk about something that's going to be extremely detrimental. It's those two things. Think about small business owners, people that own land, ranchers, farmers. That is going to have a lot of negative connotations. In fact, the regional economic models did a study and said that over 10 years, this is violently going to tax people, and it's going to cost 745,000 jobs on the low end. And the Treasury Department is saying that this is no big deal. Look the other direction. We've run our own analysis. It's okay. But they're looking at raising corporate taxes, doing a mark-to-market for taxing unrealized capital gains. They're even going as far as wanting to, like you just alluded to, taxing buybacks, looking at an excise tax, and taxing corporations whose CEOs make more than the average employee. Right. Which those CEOs are in those positions for a reason. Now, granted, they've certainly found a way to some loopholes to game the system here, making, millions and millions of dollars each year. But at the end of the day, I mean, this is a lot that's on the docket here. Right. And you have all these the environmentally friendly taxes. Yeah. They want to tax a barrel of oil. We want to tax your carbon footprint per ton. I mean, this is a lot. This is a very aggressive thing. Now, I think that many of these are going to be difficult to get through, but their agenda has been pushed up. They want to start voting on this September 15th and on October 1st. So they want to have both these bills, the bills through. So, one thing that they're doing right now is the $1 trillion infrastructure bill and the $3.5 trillion, social program or welfare bill. They're not putting those two together. So they may have a difficult time getting some of these through. I expect there's going to be a lot of horse trading.
Yeah. Look, the $3.5 trillion human, what they call the human infrastructure bill, will get pared back. It's going to get pared back. It'll be, if I had to guess, probably somewhere around trillion and a half, probably in line with the infrastructure bill. That's still a lot. I mean, you're still talking about $2.5 trillion of additional spending. But I kind of want to run back through these taxes real quick, because there's a lot of these are, kind of wish list taxes, but there's also some taxes that really may not, I'm not going to argue with. I'm going to say, hey, there might be a benefit to a couple of these tax ideas. One is the taxing of buybacks. We have talked about buybacks for a long time now. It's been one of the major problems, and it's the direct impact to the spread between CEO compensation, or I should just say executive compensation, versus workers. And, if you're an executive in a lot of these companies, Jamie Dimon is a good example, was just granted like $750 million worth of stock options. He's the highest paid bank CEO in the country. He makes a massive amount of money relative to the average worker at JP Morgan Chase. And look, he's run a very successful company. He certainly deserves to be well compensated, but there's a point to where that compensation gets a little, I don't think you can argue it's gotten just a bit excessive relative to the job he actually performs. And that strips away money that should be going back to shareholders of companies, either through dividends or some other form of compensation. And the job of any CEO of any company is to ensure their shareholders make money. That's their job, ultimately, and that's how they should be compensated. So the tax on stock buybacks is interesting because that would potentially slow or greatly reduce a lot of this capital that's been, over the course of the last decade in particular, shoved back into stock buybacks because companies are opting for basically improving their share price to keep their stock price high so that their executive compensation increases because of their stock, the stock buybacks that they're doing and the impact on the shares they own, versus investing in new capital plant, equipment, raising wages, those type of things for employees. So there may be an actual, it's not a terrible idea. I'm not sure it's the right approach in fixing the stock buyback problem, but it would certainly potentially head in the right direction. Your thoughts?
Well, if we ever saw higher interest rates, I think that would help eliminate some of the problem as well, because money's so cheap, they can go out and issue debt, turn around and go buy stock. And of course, it's filling their coffers, and everybody's bank accounts are going up if you're on that CEO or the executive level. So these guys love it, and they're all thinking short term because they don't need to worry about this in 10, 15, 20 years. They're going to be out the door with their golden parachutes.
Right.
They've got a pretty good gig there. And so I think that, those two things are going to go hand in hand. But what happens when you have a market where the breadth is so little, you have so little volume? And if you look, it's a lot of the corporations that are pushing, these things up. What happens then? But do you have true price discovery, Lance? That's going to be the key.
Look, if you go back to 2016, 2017 in particular, and we wrote articles about this, stock buybacks made up nearly 100% of all the net purchases of stocks in the market. So stock buybacks were holding the markets higher. And I will bet you by the end of this year that we're going to see a lot of the same thing, that a lot of the stock buybacks that have been done, because look, these stock buybacks are being done in billions of dollars. They swamp the retail investor. So I have a suspicion by the time we get to the end of the year, we'll look back and go, yeah, it was another year where 90 or 100% of the entire net purchases of equities came from corporations. So, the problem with higher interest rates is that impacts everybody. That impacts the little guy. It impacts the middle guy. It impacts the worker because they live on debt primarily. So, higher interest rates would certainly solve your problem with buybacks, like you said, but that actually is more insidious through the entire economy. And, just taxing buybacks, maybe that's a good idea. And taxing, these carried interest loopholes that have existed for hedge funds for a long time. That's probably something that could be done as well. That would help raise some additional tax revenue and really doesn't impact that many people. It's a very small amount of people. But I agree with you in terms of, this idea of estate taxes, because this is something that millennials in particular should be voting against, because they're the ones that stand to inherit several $1 trillion of capital through estates getting transferred to them, and they're voting for the very thing that's going to strip a lot of their wealth away from them if they do pass these higher estate taxes.
Well, I think it's that they don't understand exactly what that means to them. I've had a lot of clients in the past say, oh man, I can't, my kids feel one way about millionaires. They think they're terrible. And then I tell them, well, hey, if I die, you're going to be a millionaire. And they're like, whoa, hey, their thoughts change very quickly. And if people knew more, I think that needs to be a discussion amongst people about how that actually works. This is going to be the largest wealth transfer from baby boomers to the millennial generation that we've ever seen. And so this is going to have a significant impact. And this is something that's extremely aggressive. Initially Biden was saying that he wanted to do this tax. And so it's basically double taxation if you do capital gains and the estate tax.
Right.
Over anything over $1 million. that's a lot of people. I mean, that's a lot of small businesses. So think about what happens there. You're going to have to increase you're going to decrease your headcount. You're going to likely have to just to make ends meet here when somebody passes. If you have that transfer of a business, or you have that ranch or a home that you've had in the estate for a long time, these are things that are going to be liquidated.
Yeah.
And it's going to have a significant impact, I think, on jobs. It's going to have an impact on pricing. You know, we could see inflation from that as companies have to increase their prices just to make ends meet to pay these lofty tax bills.
Yeah.
And
I just have a suspicion, though, that all these taxes sound great. I think there's even a lot of moderate Democrats that are going to vote against a lot of these tax hikes, which may stall this whole budget expansion that they're trying to do in Congress over the next month or so. I think this will be a very interesting kind of battle to watch here. When we come back from the break, 15% correction by the end of the year. That's what Morgan Stanley's saying. We'll talk about the risk of that and your money with Danny Ratliff. Don't go away. You know, it's really important to understand what you're voting for and the things that you are asking for, and there's implications to all of these things. And you know, it's interesting if you ever look at every morning we have to look at Google Trends to see kind of what are the keywords that people are searching for and those type of things. And the stuff that people search for is amazingly vapid. I mean, it's just, you know, there's a lot of stuff is like, really, this is what you're interested in looking at. You know, there are big important issues. And again, there's an old saying, it says you get the government that you vote for. And the problem is that so many Americans are financially illiterate and they don't want to know about finances. You know, they want to know about how to trade stocks, right? Or buy Bitcoin because it's going up and they can make some quick money with it. But really understanding the dynamics of finance, understanding the importance of how money works within the economy, not just for you personally, but in the economy, has very profound impacts. And the reason that 80% of Americans don't have any money saved in the bank, the reason that 90% of Americans, you know, carry excess debt, the reason that the vast majority of Americans have to go into $4,000 a year of debt just to maintain their standard of living is all because of simply the function that we don't understand basic finance. And we don't teach it in school. We don't teach it to our kids to any great degree. And then when there is this idea and the media promotes these ideas of unfairness within the economy, it's like, yeah, let's go tax the rich, without thinking about what the trickle down effect of those things are going to be. And let me tell you one thing here, and then we'll get to our bigger story. There is a reason why the rich are supporting socialistic ideas. The reason that the rich support socialistic ideas is because it passes the tax burden from them to the lower class. There's no socialist country where there is a big middle class. It is either predominantly a small class with a very large smaller class with a very rich elite, and the smaller population that have the least amount of money, they're the ones that are supporting the vast majority of the economy. So socialism is not something that creates equality among people in terms of wealth. It creates equality in terms of poorness among people. Everything moves to the very lowest level, and it passes the tax burden from the rich to the poor. So this is why socialism sounds great on the surface until you realize why the rich are going along with this, and actually the rich are supporting the ideas. Guys like Bernie Sanders, there's a reason he's supporting these ideas of socialism, right? He's got multiple properties all around the country. He's financially well off. Why is he supporting socialism? Considering he used capitalism to get his wealth to begin with. Just something to think about.
Well, he knows exactly how this is going to work. And, you know, one thing that I do see predominantly happen amongst wealthier families as well is that they're teaching their children about finances. They're bringing them into meetings. And you don't see that with the lower middle class. You don't see that same type of communication amongst, you know, with their kids and their family, and teaching them things as, you know, to give them that experience. And I think that's where you also see a leg up. I mean, there's a gaping hole in personal finance 101. You know, this $3.5 trillion infrastructure bill we've talked about, or I guess it's not the infrastructure bill now, but it's, you know, the social programs, the education. I really hope that the education aspect, at some point, they start to focus on those things where they are communicating these things in school. Most kids get out of high school, they don't even know how to write a check. Not that people write checks that often anymore, right? But they sure as heck know how to get on Robinhood or trade Bitcoin or, these little things, which I think these are good, but they don't understand the markets and how they actually work. And most of these people have never even seen a market, but we've seen a decline.
Right.
And that's another bigger problem. And so, but talking about that Finance 101, one thing I do want to mention is that Richard Rosso and I are going to be doing a retirement right lane class. It's going to be in the Woodlands. We're actually going to do this in person again on the 18th. So go to realinvestmentadvice.com. Go sign up. We'd love to have you there. We are, just because people are going to be distanced a bit, not going to have as much room as we typically do. So, it is filling up quickly. I would recommend going and signing up. Everybody's going to have their own space. But we're going to talk about all these agenda items, right? We're going to talk about the taxes.
So basically what Danny's saying is they rented 27 hotel rooms. So, they're just going to go door to door and have the class. So
we're going to knock on the door. You're going to stand. Yeah, no, that's not how it's going to work. But,
I know.
But we're going to be talking about all these things that we talk about on the show, from a tax perspective, from how do you invest and keep money in your pocket? What are all these things that, you need to be prepared for? And, kind of a segue, I guess, Lance, talking about Morgan Stanley you brought up, their CIO is predicting a 10 to 15% crash before the year end, which, let's face it, that's pretty typical in any given year that you're going to see a 10% pullback.
This is the funny thing, right? It's like, and you said it too, and this is how the headline reads: a 15% crash is not a crash, right? That's a correction. That is a normal intra-year correction that virtually happens every single year in the market. 5 to 10% correction is completely normal. And yet now it's been so long since we've had a correction of any consequence. We have one of the longest stretches on record without a retest of the 200-day moving average, which is only 10% lower than where we are now. So again, not that big of a deal, but a very long stretch here. But it's been so long since we've had a correction that of 5%, of 10%. I mean, we have a correction of 1 or 2%, and CNBC starts running markets in turmoil. It's like we're down 1% for the day or 2% for the week. Markets in turmoil. We gotta get all the experts on why the market just crashed 2 whole percent. The problem with a 10% correction, it's going to feel like a crash because we haven't seen that type of pullback in markets in so long now. People have forgotten that that's even possible. And it's amazing how fast
psychology.
It's just amazing how fast we forget. We just had a 35% correction in March of 2020, and everybody's completely forgotten about that. Because of $120 billion in QE, and it's been a great ride from the lows. If you happen to buy the very bottom, you've done great. Most people didn't, but that's where you are. But again, this is it is interesting because this all kind of ties in. And you brought up an interesting point. You said most kind of a lot of these young millennials and things that are coming in the market. Gen Zers are a really interesting group. Gen Zers were born between 1995 and 2005. And that means in 2009, they were basically 5 to 16 years old. Right. So they weren't even old enough to invest in the markets or really understand what happened in the markets during the financial crisis. They've only seen a market over the last 10, 11, 12 years that has done nothing but just go up. So a lot of these kind of Gen Zers, they're doing a lot of the things that we've seen in the past, taking on personal debt, taking on credit card debt, et cetera, to invest in markets, because they really don't understand the consequence of what happens when you ultimately right now, it seems like there's a no-risk game, right? I take an equity loan out of my house. I invest in the stock market. I've got my house, and I'm making money hand over fist in the markets. Why wouldn't I do that? The problem is that ultimately what they don't understand is there's going to be a crash, and you're not only going to lose the value of the assets in your portfolio, now you're also stuck with the debt. So, these are the type of financial behaviors that we don't teach kids, and they're going to learn the hard way. And this is what damaged. We saw this happen after the dot-com crash. We saw families devastated after that dot-com crash for exactly the same reason. Saw the same thing happen after the financial crisis. And it's going to happen to the Gen Zers in the next crisis when it occurs. And it's not a function of when it occurs. It's just a function of if it occurs, but when it occurs. It's just a function of time. But they're also going to be devastated by it. And it's going to, and this is what keeps perpetuating this problem of wealth inequality in the country. Rich people don't make stupid investment decisions. Poor people do.
Well, I think everybody makes stupid investment decisions
Well,
at one time or another, but
yeah.
well, it's because it's a very emotional. And so,
My point though is that yes,
yeah,
everybody makes them, but you don't make massive ones. The reason that people have wealth is because they've been fairly smart about making their investments either in businesses or real estate or whatever it is. And you take a look at
correct.
high net worth individuals, they don't have 100% of their money in the stock market. The vast majority of their money is in bonds, cash, and real estate, and they have about 20% of their equity ownership in the stock market.
That's right. But you can also make the argument that that's not there for the lower income classes to take advantage of.
Sure.
You know, and that's always going to be the argument, and that's an argument that'll stand the test of time as well, because you don't have that same type of opportunity as somebody who has a lot more money, and that's easier to accumulate wealth when you have wealth. And so I think that that's a difficult problem to overcome, and we're not going to do it by these social welfare programs.
Right. Well, and look, and again, going back to the education part, getting yourself into debt to live a standard of living that you shouldn't be living, right? Buying a $350,000 house versus a $150,000 house, right? That's what keeps you from building wealth. There's stories, endless stories of people that came to this country with a nickel in their pocket, literally, and built multi-million-dollar empires for themselves, through starting a dry cleaner or, going door to door, washing cars, whatever it was. There's all these stories are out there and they're plentiful. Books have been written, Billionaire Next Door, right? You can build wealth. You have the opportunity. Everybody has opportunity. And that's the beautiful thing about capitalism. Everybody has the ability to participate in the system and to build wealth. It's just a function of, do you want to sacrifice today for what you want tomorrow? This is one of Dave Ramsey's famous lines is, live like nobody else today so you can live like nobody else tomorrow. That's absolutely the basis of capitalism. We just choose not to do it because a younger crowd wants to YOLO, right? You only live once, so let's spend it all today because you may not be here tomorrow.
What a great marketing scheme, right?
Right? Look, credit card companies and banks are predatory in this very manner. They're the ones that are offering out people credit cards that really have no ability to and no need to be getting further into debt. The banks are complicit in creating the wealth disparities that we see in the economy. Quick break, we'll be back, wrap up the show. We'll get back to that crash part. I meant to tell you, we'll tell you why that may be the real issue coming up right after the break. Going back to this idea of this 10 to 15% crash in the markets, Morgan Stanley talking about this yesterday, something that really is not that far-fetched. And again, it's been so long since we've seen a correction. It's hard to imagine such. And I've done a couple of interviews this week. I did one with Business Insider day before yesterday. I did one with Market Watch a few days ago. And it's interesting because they call me up and they ask me a question. They're like, Lance, so you think there's going to be a crash, coming? I was like, no, that's not what I'm saying. What I'm saying, and if you read what I wrote, is that a 5 to a 10% correction is very likely and it's very normal. Well, that would be like a crash, right? I mean, it could go down 20%. It's like, well, yeah, that's possible, because once that you start a correctional process that's been larger than you've seen in the past, like over the last year, and there's no volatility, when the people start running for the exits, they can tend to run, further past the exit than you expect. So sure, it's we could go to the 10% correction to the 200-day moving average and go right through it. Particularly if you start kind of a seller stampede, certainly possible. So, it's possible. You need to be aware of the risk. That's the point, right? So the headlines come out. Strategist says there's going to be a 20% crash in the markets. That's not what I said at all. But, it makes for great headlines. But the important thing to understand is we've gone a very long time without a correction. And the odds of a correction are growing simply because of the length of time that you have gone without a correction. And you can't have a moving average without the prices of the prices trading both above and below that average over a period of time. So you're going to have a correction. The only question is what causes it. That could be the Fed coming out this month. I think week after next, we've got the Fed meeting, and they could be saying, hey, you know what? We're going to start tapering now, right? The markets aren't expecting that. It'll be something unexpected and exogenous that creates a shift in psychology that leads people to start selling, and selling will beget more selling, and you'll get a correction. That's not the end of the world. I would love a correction simply because I've got 20% in cash I need to put to work. And I'm waiting for an opportunity to buy some stuff that I want to buy cheaper. That's it. It's an opportunity to invest capital, not to be all worried about it. But again, headlines is what gets clicks, right? So we need to be dramatic about these things. But look, markets are very extended. They're very overbought. There's very weak internals, no matter how you measure it. Number of advancers and decliners, 50-day stocks above their 50-day moving average, stocks above their 200-day moving average. Very, very weak internal participation, very low volatility, highly complacent markets. These are all, this is basically the kindling for the fire. What you need is a match. And nobody knows today, tomorrow, next week, next month, what that match will be. It won't be the Delta variant. It won't be economic data, because we already know that stuff. It's already priced into the markets. It'll be something that the markets are not aware of. And this is I use this analogy a lot because it's very appropriate for how markets work. And I had a good question this morning. I was talking about Bitcoin and this kind of crash in Bitcoin that occurred yesterday. El Salvador says, hey, we're going to accept Bitcoin as legal currency. And as soon as that happened, there was a 20% plunge immediately in Bitcoin. Margin accounts were being liquidated. I mean, it's just nightmare for guys. But this is the point about the markets. The question I got was, well, how come you don't have this disorderly move on the way up, only on the way down? So it's because it was going into the theater, everybody's being completely normal, right? You walk into a movie theater you with your popcorn and your kids, and you slap your kid in the head to get him to sit down where he's supposed to sit down. And not really, I'm just teasing. People are like, child abuse. But you get your kids, sit down, you get them all in the right place. It's orderly to some degree, right? It's orderly going into the theater. So everybody's now in the theater, right? And this is the markets. This is how markets work. The entrance into the market is very orderly. And then some Yahoo on the very front of the row stands up and starts screaming fire, right? And now all of a sudden everybody's just in a panic rush. They're just throwing everything down, stepping on kids, trying to get out of the theater. That's the problem with markets. The exit from the theater is not orderly. And everybody's trying to get through a very small exit all at one time. And this is why you have these kind of gentle, these rises up are, you run at a 45-degree angle basically, and then your exit is a 90-degree decline. So that's just how markets work. The exits are never orderly, and it's that panic to get out of markets that create these very sharp declines. And so that's why you can have a 10 to 15% correction very quickly in markets. Will it occur? Yes. When will it occur? Have no idea. But it is coming. Will it happen before the end of the year? It depends. I think a lot of it depends on what the Fed does. And, the Fed member Bullard out this morning talking about we need to taper sooner than later. And I think that's the risk, is that the Fed does something that the markets aren't expecting. The markets don't expect the Fed to taper at all. They're looking at the employment report going, that was weak enough to keep them from tapering. I don't think they're paying attention to inflation. Danny mentioned this earlier. Wage inflation is soaring right now. Inflation by the end of this year will be north of 4%. I think that puts the Fed into a bad position. You've got weakening economic growth and rising inflation. They're going to be trapped between, do I support economic growth or do I combat price stability? And I think price stability potentially wins out. That's not what the market's thinking. That's what creates your correction. But that could be now, November, December, could be January, February. Don't know when that's going to happen, but it'll happen. So, Danny, thoughts?
Well, going back to our conversation last segment, nobody wants to talk about all of the things that you should be doing to protect assets. Nobody wants to talk about when you had 50 new all-time highs in 1 year, that maybe it would be a good time to take some chips off the table. It's like we talked about with all of the YouTubers who are now out there, and basically they're not professional investors, but they just talk about what they do all day and they invest. And you've said it. Mm-hmm. Nobody wants to hear about what do you do if something goes wrong or the market goes down. They only want to hear about how you can make money quick. What's the quickest way to go make money? And everybody, you got to be all in. And nobody has that process on, trying to protect assets. And that's where I think the bigger problem lies. And that's why everybody hits the exit all at once, because there is no orderly exit. There is no way for people to, if you don't have a plan or a strategy, and everybody hits it at once, you think, oh shoot, I've got to go too. Well, then it's too late,
right?
Because now you're at the back of the line and you're waiting your turn to get out. And unfortunately, in markets, it's likely going to be at a much lower price than what you wanted. But by that point, you're thinking, oh my gosh, I've got to protect what I have. And that's where I think this becomes much more problematic. And, that big event that occurs, who knows what it will be. The one thing I do disagree with a little bit, Lance, was that think back to 2018. We knew they were raising interest rates. Mm-hmm. And yet the market dropped 20% in that fourth quarter.
Right.
So some of these things may be something that we do know is coming. And it's just a matter of, like at that time, Powell said, hey, we're a long way from neutral, suggesting that there were going to be many more interest rate hikes than what we expected.
That was what the market didn't expect, was that statement.
That's true.
And that was, and again, the market didn't expect that. The market was okay with him hiking rates, but the market thought he was almost done by September of hiking rates. Then he comes out with that statement, oh, we got a long ways to go. And the market was like, oh, we didn't price that in. And that was the problem. So the point is ultimately is whatever triggers it. It'll be something, to your point, very unexpected. Kind of like George Costanza at the birthday party, and the kid yells fire. He's like pushing the kids out of the way to get out of the house. That's what it's like when it happens, and we kind of forget that. I had a couple of questions. What about Evergrande, which is this major Chinese conglomerate that is virtually going into default now? We talked about this a bit yesterday on the show. It's the Lehman potentially of China. Is that something that triggers the markets? Maybe. Probably not at this point. I suspect the Chinese government will just bail out the bank and bail out all their subsidiaries that need financing. They have a tendency to do that. So I doubt that's going to be the problem. Another question was, what about war with Taiwan? The problem is those geopolitical risks are out there. The market's already aware of it. And, if all of a sudden tomorrow we woke up and there was war with Taiwan and the U.S. was getting drug into it, markets may take a hit for a day or two. Then the market's going to go, hey, wait a minute, war's good for the defense sector. Let's go buy defense stocks. So, we can look back at history, Afghanistan and everything else, going back to the war on terror after 9/11. Markets didn't react very negatively to those events. In fact, go back to 2001, 2002, as we were finishing the dot-com crash, it was actually going into Iraq that actually started to form the bottom in the markets at that point. And turn the markets up because money started flowing back into the defense sector. So, again, it's just, the thing that's going to disrupt the market is going to be something credit related. Evergrande could be that risk. I doubt it because I think China will bail them out. I could be wrong. We'll see. But generally, the thing that really upsets the market at some point is something on the credit side. And whatever causes that is something we just don't know because, again, it'll be something that is unexpected. Last couple of points here. Just wanted to kind of wrap up as we get showed. So, Danny, when is your lunch and learn?
So, no, not lunch and learn. We're actually doing this in person, Lance. Come on. It's going to be September 18th. It's in the Woodlands at the Hyatt Centric. We'd love to see you guys out. This is going to be our first event, and I feel like it is years that we're going to do something live. So it'll be nice to actually, see people, have conversations. And so go sign up, realinvestmentadvice.com. We'd love to have you guys out. Lots of good questions, lots of great information, especially in this kind of uncertain period where we don't exactly know where taxes are going. But we can give you some good ideas as far as what you can do to keep more money in your pocket.
Right, and that's on the 18th. So sign up now. If you simply go by the website, realinvestmentadvice.com, scroll down to our events section. You can simply just sign up there for it. We'd love to see you there. It's always a lot of fun. Danny, thanks so much for your time today. Be sure and stick around. 3 minutes on markets and money are coming up. We're going to talk a little bit more about Bitcoin this morning on our 3-minute episode, what happened yesterday and what this might mean for Bitcoin's future. Also, we've got our latest reports out on our website. Michael Leibowitz has a very interesting report out this morning talking about inflation and the housing number inside of inflation. This homeowners equivalent rent is completely BS, and he gets down to the bottom of that in this morning's article on the website, realinvestmentadvice.com. So get by the website. You'll find everything you want there, from our video, our podcast, as well as our blog post and our newsletter. It's all there for you. realinvestmentadvice.com. See you back here tomorrow.